You've saved £250,000 in your pension, and you're finally ready to start taking an income. You've done your research, compared UFPLS to drawdown, looked at annuity rates, and you think the big decision is which product to choose. It isn't. The real risk is the emergency tax code that HMRC automatically applies to your very first pension withdrawal. That code can take up to 40% of your first payment before you even see it. And getting that money back can take months. I've been there myself. When I took my first UFPLS, I thought I'd done everything right. Then I saw the net payment and nearly fell off my chair. In this video, I'm going to walk you through exactly how that tax code trap works, the checklist you need to complete before you request a single pound, and how to get your money back in weeks instead of months. Because choosing the right pension product is only half the battle. The other half is making sure the system doesn't take your first few months of retirement before you've had a chance to enjoy them. There's also another cost that most retirement guides ignore completely. From the 6th of April 2027, unused pension pots will be pulled into your estate for inheritance tax purposes. If your combined assets are over the nil rate band, the wrong strategy now could cost your family tens of thousands. We'll cover that too. If you're within 5 years of retirement and you don't want to lose a month's income to a tax code error, hit subscribe now. I'll show you the exact steps to protect your first withdrawal. When you take a UFPLS or move into Flexi Access Drawdown, your pension provider has to report that payment to HMRC. The problem is that HMRC doesn't know your full income picture at that point. They don't know how much you earn, what other pensions you have, or whether you've used your personal allowance. So they apply an emergency tax code. For a £20,000 UFPLS withdrawal, 25% is tax-free. That's £5,000. The remaining £15,000 is taxable. With a BR emergency code, you pay 20% on the full taxable amount, which is £3,000. With a D0 code, you pay 40%, which is £6,000. If your correct tax on that £15,000 should have been much lower because of your personal allowance, that gap is money sitting with HMRC while you wait. That money isn't gone for good, but getting it back takes time, and often more time than people expect. HMRC aims to process a P53Z reclaim form within 30 days. In practice, the average wait is 6 to 8 weeks. That's 6 to 8 weeks without access to money that is rightfully yours. The 3 emergency codes you need to know are BR, D0, and D1. BR taxes the full taxable portion at 20% with no personal allowance applied. D0 taxes it at 40%. D1 taxes it at 45%. HMRC will apply whichever code your records suggest, and if you've never been in PAYE employment or have been out of it for some time, they'll often default to BR. The result is that your withdrawal is taxed as though it's your only income for the year, but with no allowance offset. Most people only discover this when they check the net payment figure. They call their pension provider, who tells them it's an HMRC matter. They call HMRC, who tells them to fill in a form, and in the meantime, the money sits with the government. There's a second trap that's less well known. The moment you take any taxable income from a defined contribution pension, the Money Purchase Annual Allowance kicks in. The MPAA caps your future pension contributions at £10,000 per year. If you're still working and had planned to carry on putting money into a pension while drawing income, that cap changes the picture significantly. Most people don't realize it until it's too late to undo the first withdrawal. If you're a near retiree who's been told that UFPLS is straightforward and the tax sorts itself out automatically, you're being set up for a shock. The system is designed to collect first and correct later. That's not a failing of any one department. It's simply how PAYE and emergency coding operate. But knowing that in advance means you can protect yourself before it happens. So you now know the trap. But here's the part that really stings. Even if you navigate the emergency code perfectly, the 2027 inheritance tax changes could permanently alter the value of anything you leave behind. That's where we go next. The good news is that you don't have to go through any of this. You can fix your tax code before your first withdrawal, and if you do it at least 2 weeks in advance, Your provider gets the correct code from day one. I used to think the tax code thing was a minor annoyance, just a form to fill in later after the money had arrived. Then I helped a client who had been overtaxed by £6,000 and waited 14 weeks for a refund. That's when I understood that the sort-it-out-later approach isn't just inconvenient, it costs real money and real stress. Here is a simple 3-step process. Step 1. Before you make any withdrawal, estimate your total taxable pension income for the tax year. Include your state pension, if you're already receiving it, any defined benefit pension income, and the taxable portion of any DC withdrawals you're planning. With a UFPLS, remember that 25% of each withdrawal is tax-free and 75% is taxable. So if you're planning a £30,000 UFPLS, your taxable amount from that withdrawal is £22,500. Step 2. Contact HMRC before your withdrawal. You can use the Check Your Income Tax service on gov.uk. If you'd rather call, the number is 030-200 3300. Have your national insurance number ready. Tell them your estimated income for the year and ask them to issue a tax code that reflects your personal allowance and the correct rate band. The personal allowance for the 2026 to 2027 tax year is £12,570. Step 3. Wait for the new tax code to reach your pension provider. This usually takes 2 to 3 weeks. Don't make your first withdrawal until you've confirmed the correct code is in place on your provider's account. To show you what this saves in practice, if you're planning to take £30,000 as a UFPLS in the 2026 to 2027 tax year, your taxable portion is £22,500. You also have a state pension of £11,500. Your total taxable income is £34,000. After the personal allowance of £12,570, you owe tax on £21,430, which at the basic rate of 20% comes to £4,286. If HMRC had applied a D0 emergency code instead, you'd have paid £9,000 in tax on that single withdrawal alone. That's an overpayment of more than £4,700. One phone call, made 2 weeks in advance, is the difference. That checklist will protect you from the emergency tax trap. But there's another hidden cost that most retirement guides never mention. From the 6th of April 2027, unused pension pots will be included in your estate for inheritance tax. If you're still following the old advice to leave your pension untouched and let it grow, you could be building a larger bill for your family rather than a legacy. For most of the past 2 decades, a defined contribution pension was one of the most effective wealth transfer vehicles available in the United Kingdom. The reason was simple. When you died, your unused pension pot sat outside your estate. That meant no inheritance tax. Your children or grandchildren could inherit it without that 40% charge cutting into what you'd left them. That changes from the 6th of April 2027. The 2024 autumn budget announced that unused DC pension pots will be brought within the inheritance tax rules. It is now law. After that date, any pension pot you leave behind will be included in your estate, and anything above the nil rate band of £325,000 will be taxed at 40%. To put a number on that, if you have a £500,000 pension pot and you pass away after the 6th of April 2027, the value above £325,000 is £175,000. The inheritance tax on that is £70,000. Your family receives the pot minus what HMRC takes first. For people who have been deliberately delaying crystallization to let the pot grow in a tax-advantaged environment, this is a significant shift. The old strategy assumed the pension was an inheritance tax-free asset. After 2027, it isn't. If you've been holding back from touching your pension because you want to leave it to your children, you may now be handing them a larger tax bill alongside it. The question this raises is one that a lot of people in their late 50s and early 60s are now working through. Should you accelerate spending from the pension or begin making gifts instead of growing the pot? There's no single answer that works for everyone. But the first step is understanding that the advice you were given 5 years ago may now produce a different outcome than you expected. This doesn't mean you should panic and start draining your pension immediately. What it means is that the strategy you use to take income from your pension now has a direct effect on what your family receives later. That conversation is worth having with a professional before the 6th of April, 2027. So the inheritance tax change flips the old advice on its head. But before you rush to start spending everything down, let's look at why so many people, even with all of this information in front of them, still freeze and do nothing. One of the most common comments under retirement income videos is some version of, "I'm more confused now than before I pressed play." If that sounds familiar, you're not alone, and it isn't a sign that you're not paying attention. The financial industry presents UFPLS, Flexi Access Drawdown, Phased Drawdown, annuities, blended strategies, and more, often without a clear decision framework. The brain responds to too many equally weighted options the same way every time. It freezes. You tell yourself you'll decide next month. Next month becomes 6 months. 6 months becomes a year of doing nothing while the decisions quietly pile up. I remember sitting at my kitchen table with a spreadsheet that had 14 tabs. My wife came in and asked what I was doing. I said I was optimizing my retirement income. She said, "Just pick one and let's go on holiday." She was right. The reason this happens isn't a lack of intelligence or willingness. It's that the system presents complexity as if complexity were thoroughness. The more options you see, the more it feels like you need still more information before you can act. That feeling is the trap. Here's one reframe that removes most of the noise. Ask yourself one question. Do I need predictable income to cover my essential bills, or do I want flexibility for spending that varies month to month? If your answer is essential bills, you want guaranteed income. That means an annuity, or using your state pension, and any defined benefit income as your income floor. These products exist precisely to take the variable out of the equation. If your answer is flexibility, drawdown or UFPLS can both work well, but only after you've fixed your tax code using the checklist we covered in Section 3. That sing question removes 80% of the complexity. You don't need to model every scenario or compare 12 different products. You need one clear answer to one clear question, and then you act on it. So you've got the checklist, you understand the inheritance tax trap, and you have a simple decision rule. Now let's put all of that together with a concrete example so you can see exactly what this looks like in practice. Let me walk you through a real-world scenario so you can see how this plays out in practice. You're 62. You have a £200,000 DC pension. Your state pension of £11,500 a year starts at 67. You have no defined benefit pension. You want an extra £15,000 a year from age 62 to 67, and then a smaller top-up of around £5,000 a year once the state pension kicks in. 2 paths. Path 1. No tax code fix, no inheritance tax planning. You decide to take a single large UFPLS of £75,000 in year 1 to give yourself a 5-year buffer. HMRC applies a D0 emergency code. The taxable portion of that withdrawal is £56,250. Tax at 40% comes to £22,500. You eventually reclaim the overpaid portion, but you've spent 2 months without access to money you'd planned to use. The remaining £125,000 stays inside the pension. After the 6th of April 2027, that pot sits within your estate. If you pass away at 70, your beneficiaries lose 40% of anything above the nil rate band. Path 2. You contact HMRC, fix the tax code, and then take a UFPLS of £20,000 each year for 5 years. Each year, 25% is tax-free, which is £5,000. The taxable portion is £15,000. With a personal allowance of £12,570, you owe tax on just £2,430 at 20%, which is £486. Over 5 years, your total income tax on pension withdrawals is £2,430. By spreading the withdrawals annually, you've also been drawing down the pension steadily, which reduces the inheritance tax exposure. By 67, when your state pension starts, the pension pot has reduced to around £100,000, assuming 4% annual growth minus withdrawals. You then take a smaller £5,000 a year from drawdown. The pot lasts well into your 80s, and the inheritance tax exposure is minimal because you've drawn it down in a planned, tax-efficient way. The difference in actual tax paid between the two paths is close to £9,570 over 5 years. That's not an edge case. That's the straightforward result of one phone call to HMRC and a simple annual withdrawal plan. And the most important step is the one that happens before you make any call to your pension provider. Let me give you the exact words to use when you contact HMRC. Here are the 5 steps to take before your first pension withdrawal. Step 1. Estimate your total taxable income for the year before you do anything else. Include the taxable portion of any UFPLS or drawdown you're planning, which is 75% of each withdrawal. Include your state pension if you're already receiving it, any defined benefit income, and any other earnings. Write that total figure down. You'll need it when you call HMRC. Step 2. Contact HMRC before you request the withdrawal. You can use the Check Your Income Tax service on gov.uk. If you prefer to call, the number is 0300 200 30300. Have your national insurance number with you. When you get through, you can say something along these lines. I am about to take my first pension income. My total taxable income for this tax year will be approximately a certain amount. I'd like to request a tax code that reflects my personal allowance and the correct rate band, please. If you have other income sources, mention them at this point. Step 3. Wait for the new tax code. HMRC will issue an updated code to your pension provider. This typically takes 2 to 3 weeks. Do not make your withdrawal until you can confirm the correct code is in place. Your provider's online account will usually show the current tax code on your pension. Step 4. Make the withdrawal. Once the correct code is confirmed, go ahead. Keep a screenshot of the tax code confirmation in case there's a query later. Step 5. If you're still overtaxed despite all of this, it does happen occasionally. If you've taken your entire pension pot as a single lump sum, use Form P53Z. If you're taking regular income over time, use Form R40. Both are available on gov.uk. Submit online and expect the refund within 4 to 6 weeks. A viewer of this channel followed this exact process. He called HMRC on a Tuesday, had his code updated by Friday and took his first UFPLS the following Monday. His net payment was exactly what he had calculated in advance. No shock, no reclaim form, no weeks of waiting. If this checklist is useful to you, hit subscribe, because no one should lose a month's income to a tax code error that takes less than 20 minutes to prevent. Let me bring this together. The question in the title of this video is whether UFPLS is the best way to take your pension income. The honest answer is that no single method is best for everyone. UFPLS works well for some people. Drawdown works better for others. An annuity is the right answer if you need a guaranteed income floor. But the method you choose matters far less than the preparation you do before you choose it. 3 things to take from this video. First, fix your tax code before you make your first withdrawal. Call HMRC at least 2 weeks in advance, give them your estimated income for the year, and wait for the correct code to reach your provider. This single step can save you thousands and weeks of waiting. Second, understand how the 6th of April 2027 changes the picture. If you have unused pension above the nil rate band of £325,000, the old advice to delay crystallization and let the pot grow now creates an inheritance tax problem for your family. The strategy you use today affects what your beneficiaries receive. Third, use one simple question to cut through the noise. Do you need predictable income for essential bills, or do you want flexibility? The answer to that question points clearly to the right approach, without needing 14 tabs on a spreadsheet. My goal on this channel is to give you the tools to make confident decisions, not to sell you complexity. You've worked hard for your pension. You deserve to keep every pound of it. If this video helped you, hit subscribe and turn on notifications. And if you've already taken your first withdrawal and were overtaxed, drop a comment below with your story. I read every comment and I'll reply with the exact form you need. Thanks for watching. Now go fix that tax code.